So in our last class, we discussed project duration. Of course, we talked about the discounted cash flow. We started with what is capital budgeting, what are the procedures involved in capital budgeting decision. We also discussed the two methods of evaluating projects, the discounted cash flow method and then the non-discounted cash flow method. And then we started with the techniques under the discounted cash flow method to include the net present value. So we discussed net present value, the internal rate of return, the areas of conflicts between NPV and then the internal rate of return, as well as how to resolve the conflicts between the two techniques and other techniques. All right. Then thereafter, we move to modified internal rate of return. Then finally, we discussed project duration. In today's class, I will just do a brief recap on project duration. Then we are going to have a short example. Then thereafter, we'll move to the non-discounted cash flow techniques. Okay, so we said that project duration represents the average time taken required to recoup the amount invested in a project. And we said that project duration is similar to the normal payback period, except that project duration consider all the cash flows after the duration. Unlike the payback period, after payback period, all other cash flows are ignored. All right. Not only that, project duration will rely heavily on the present value, which means that future cash flows to be generated by the project will be discounted to the present value equivalent before calculating the project duration. All right. So, and I said that when calculating project duration, if you are given a negative cash flow in year one, the negative cash flow should be ignored, should not be part of the project duration calculated. But if the negative cash flow occur in between years, that is, after year one, maybe you have a negative cash flow in year two, but year one cash flow is positive, year two cash flow is negative, year three cash flow is negative. Provided negative cash flow does not occur in year one, then of course the negative cash flow should be included. But once negative cash flow occurs in year one, you are going to ignore the negative cash flow until the project starts generating a positive cash flow. Even if you have a negative cash flow in year one, you also have negative cash flow in year two, you are going to ignore year one negative and then year two negative until the project is able to generate a positive cash flow before you calculate your project duration. That's all you need to do. And I mentioned that there are two methods of calculating project duration. You can either use weighted average method or you use present value method. Whichever of the methods that you use, you are going to arrive at the same answer. And I demonstrated how to calculate project duration using weighted average method and then using the present value method. I think that's where we stopped last time. So today I'm going to use an illustration to demonstrate that. Okay, I will use an illustration to demonstrate that so that we'll be on the same page. Then thereafter, we move to the next one. Okay.
Yes,
you can
sir.
say it. All right, thank you. Yes, let's use this short example to demonstrate project duration. Okay. A project with an initial outlay of 200,000 naira is expected to generate the following cash inflows for the next 6 years. The cost of capital is 10%. Only you are required to calculate the project duration. So these are the cash flow given to us. An examiner wants us to calculate project duration. What are you supposed to do? Very simple. Just calculate your project duration using either weighted average method or the present value method. You are going to get the same thing. All right. So let me switch to the working notes. Okay. Stop sharing this. Okay. If you want to calculate project duration, there's no need for you to say using weighted average method or using present value method. Just go ahead and use whatever method you want to use. And don't go and be showing too much skills on the day of your exam. All right? And be doing the two. You use weighted average, you also use a present value because you know too much. You don't need to do that. It's a waste of time. All right? So if I want to use weighted average, I will create a column. For the purpose of this class, let me just put it there. Okay? Using weighted average method. Like I said, on the day of your exam, don't go and be saying using weighted average method. Just go ahead, solve the question and move on. I'm doing this for the purpose of the class so that you can differentiate between the two. That's what I'm writing it out. So if I want to use weighted average, you remember I gave you the format. The first thing you are going to do is to create a column for number of years, create a column for cash flow, you create a column for discount factor because you want to calculate present value. According to this question, discount factor is 10%. The cost of capital is 10%. Then you create a column for present value. Then you create a column for the weights. This is A. This is B. This is C. This is D. D equal to B times C. This is E equal to A times D. So this is the format I gave to you last time. Okay. You will notice that from the cash flow given to us, year one cash flow is negative 40,000. So you don't include negative. Once you are given negative cash flow in the first year, you ignore the negative cash flow. So you start from the year the project start generating positive cash flow. So year two, year three,
Okay,
year
please,
four, year five, and year six.
please, can you just go up to the question so that somebody can take a picture because it's not in our pack, so that as you are solving it, one
Okay.
can be following. Yes, please.
Okay.
Thank
Let
you. I'll
me
just take a picture
quickly,
quickly.
let me scrap it and share.
Okay, received.
Okay. So everybody should open to the question. Give to me, what's the year two cash flow? Year two cash flow, what do we have there?
30,000.
Pardon?
Year two, 30,000 positive.
30,000.
30,000. Year three?
120.
Positive 120.
120,000. Year four?
150,000.
150.
Year five?
100.
100,000. Year six?
50,000 positive.
50,000 positive. So these are the cash flows. You will notice that we have ignored year one negative cash flow. It should not be there. But let's say, for example, the negative cash flow occurs in year four. Let's say this 150,000 is negative. Of course, you are going to include the negative that occur in year four. Provided the negative cash flow does not occur in the first year, it should be included. So discount factor for year two at 10% is 0.826. Year three is 0.751. Year four is 0.683. Year five is 0.621. Year six is 0.564. Please confirm if I'm correct. Okay, so at this point, we need to get the present value for each year. Therefore, 30,000 multiplied by 0.826 equal to 24,780. Here is 24,780. For year three, cash flow, 120,000.
90,120.
Thank you. 90,120. What about year 4? Year 4,
102, 450.
102,
450.
450, 62, 100.
28, 200. Yes, 6.
28, 200. Add up all the present value. Add up the present value. What do you have? We don't have a magic finger.
Almost there.
317,650.
317,650. Okay, so that is the project duration. Sorry, that is the total present value. Now to get the duration, we need to first of all get the weights, the weighted average of the present value. Therefore, you multiply number of years with the corresponding present value. So 2 multiplied by 24,780. What do you get?
Please, I got 307, 650.
307,750.
I got 307, 650.
650.
Please, somebody else can
Okay.
reconfirm.
Another
Yeah.
person should try it for me.
Is correct.
307, right?
Yes, sir.
Okay.
Yes, 307.
So, okay, thank you. So in that case, so give me the weights by multiplying number of years with the corresponding present value. 2 multiplied by 247,
49,560.
49,560. Next,
270, 360.
270, 360. Okay.
Four oh nine
Yes.
800.
409, 800,
Year 5, 310, 500.
310, 500. Somebody should be adding the weights. Christiana, add weights. You need to add weights.
169, 200.
169, 200. What's the total weight you have added? Yes, total.
Million. 1,209, 420.
1,209, 420. That represents the total weight. So in this case, I need to calculate my duration. Then duration will be equal to total weight over total present value. Of course, everything must be expressed in years. Please, on the day of your exam, if you have question on project duration, don't be too much in a rush by not putting years. It's just like you want to calculate percentage, just say 15. You did not put percentage. So if you calculate project duration, you need to indicate that you are expressing it in years. Therefore, total weight is 1,209, 420 over 307, 650. What do you have there?
3.9 years.
3.9,
Yes.
9 watts,
3.93.
93 years. Okay, that's the duration. The duration of the project is 3.93 years, which means that this project will pay back, the company will recover the amount invested within the next 4 years. So that's that. So if I want to use present value method, alternatively, let me see if this thing can accommodate. 1, 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8. Okay. So alternatively, using a present value method, using present value method, create a column for year, cash flow, discount factor at 10%, present value, then you create a column for the proportion of present value, then you create a column for duration. This is A, B, C, D equal to B times C, then E, F equal to A times E. Okay. So year 2, year 3, year 4, year 5, then year 6. The cash flow of the first year, of the second year is 30,000. Here is 30,000, 120,000, 150,000, 100,000, then 50,000. 0.826, 751, 683, 621, 564. The present value here is 24,780, 24,780. Then we have
9120,
9120,
102,450,
102, 450, 102, 450,
62,
then
100,
62, 100. Here is a 28 watts,
28, 200,
200, and we got the total present value to be 307,
650.
650. Then we need to find the proportion. You know, I gave you the procedure. The third procedure or the second procedure is to calculate the proportion of present value to the total present value. That is, you need to divide the present value of each year with the total present value. So in this case, you will say 2480, 24,780 divided by 307,650 equal to
0.08.
multiply by 100. That's
Okay. 80%.
8.1%. This is 8.1%. Okay. So into one decimal place. Then you do for the second year 90,120 divided by 307,650 equal multiply by 100. That's 29.3. Here is 29.3. Do the same thing for the fourth year, year 4. 102, 450 divided by 307,650 equal. That's 33.3. 33.3. Okay. Then for the fifth year, 62,100. 62,100 divided by 307,650. Okay, equal, that's 20.2. 20.2. Then finally, year 6. 28,200 divided by 307,650 equal. That's 9.2, 9.2%. Let me see. 1 plus 3 plus 3, that's 7, plus 2, that's 9. So we need only one. So this one will be 9.1. 9.1. You cannot be more than 100%. So due to our rounding, so this one cannot be more than 100%. Okay? Because if you put 9.2, that will be 101%. So you can't have that. You need to restrict the final one or the last one to 9.1. Okay, then. So to get the duration, all I need to do is to just multiply the proportion with the number of years. Okay. So for the first one, is 2, 8.1 multiplied by 2 equal, divided by 100 equal, that's 0.16 into 2 decimal place, because your duration will be in 2 decimal place. So this is 0.16. I will do for the next one, which is 29.3 multiplied by 3 equal, divided by 100 equal 0.88, 0.88. I will do for year 4, 33.3 multiplied by 4 equal, divided by 100 equal 1.33, 1.33. Somebody should be adding up the duration so that will be faster. Then 20.2 multiplied by 5 equal, divided by 100 equal 1.01. Then the last one, which is 9.1 multiplied by 6 equal, divided by 100 equal 0.55, 0.55. Add it up, you should have the same thing as 3.93.
3.93.
Thank you. So whether you use present value method or you use weighted average method, you are going to get the same
Hello?
answer as project duration. Yes, talk to me.
Must we divide by 100 in all cases?
Must we divide by 100? You know, you've already multiplied the proportion of the present value by 100%. So you have to divide it by 100 now. Ordinarily, the proportion is supposed to be in 0. For example, the first one is supposed to be 0.081. But because in order to make it, easier for you to comprehend, so that's why I have to multiply with 100%. And when you do that, of course, when your final answer, when you multiply, for example, 2 multiplied by 8.1, you can't be, that would be about that's 162. So you need to 16.2 rather. So you need to divide it by 100. Okay. So this is in percentage. This is Naira. This is Naira. Okay. So this is in years. This is in years. All right. So this is how, no matter how big is the question, it's the same procedure. All right, just calculate. You can see that either of the two methods, we are going to calculate present value. And the beauty about this is that when you get to bond valuation and analysis, which Mr. Shiwaji will take you, certainly you are going to calculate bond duration. It's the same format you are going to use to calculate your bond duration. All right, so let's move on. Let's go to non-discounted cash flow method. Non-discounted cash flow method. Let me stop sharing this. Okay. So let's talk about non-discounted cash flow method. Let me see. So under the non-discounted cash flow method, we have the payback period as well as the accounting rate of return. So quickly, let's talk about payback period. So what do you understand by payback period? The payback period represents the period, usually expressed in years, in which it takes cash inflow to equate cash outflow in capital investments. The payback period is a measure of liquidity, that is, how quick can a company recover the amount invested in a project. So in the determination of financial viability of a project using the payback period, cash flows should be used, which means that if accounting profit or loss is given, it should be converted to cash flow before calculating the payback period. Okay? Now, how do you convert accounting profit to cash flow? It's simple. Okay? If in question you are given accounting profit or loss, therefore, I would then say cash flow equal to profits or loss plus depreciation. So this will give you the cash flow. Let me see the charts. Sorry, I may join later, still on the, oh. So Lisa, I thought you joined I saw you the other time. It's okay, no worry. That's one of the beauty of the online, so it's recorded. All right, so move on from here. So, like I said, when you want to calculate, whether you want to calculate all the techniques using all the techniques apart from the accounting rate of return, you need cash flow. So if you are given accounting profit or loss, you are expected to convert it to cash flow before calculating payback period or any other technique. So it is only accounting profits, accounting rate of return that makes use of the accounting profit or loss. Every other techniques will need a cash flow. So and what I'm now saying is that if you want to calculate payback period, and you are given accounting profit or loss, you need to convert it to cash flow. To do this, cash flow is equal to profit or loss plus annual depreciation. That's all. So this is the formula we are going to use to convert it. Now, what are the methods of calculating payback period? Basically, there are two methods, depending on the nature of the cash flow. If you are given irregular cash inflow, you are expected to use tabular method to calculate your payback period, okay? Say, for example, this is what I mean by irregular cash inflow. The cash flow of year 1 is different from cash flow of year 2, is different from cash flow of year 3. That is what I mean by irregular cash inflow. So when you have this kind of a situation and you have to calculate the payback period, of course, you bring out your calculator to say 100,000 in year 0. Of course, this is the same format that I expected to use. So 100,000 in year 0. 100,000 minus 40,000 in year 1, we have a balance of 100,000 at the end of year 1 to recover. Then you move to the next cash inflow. You will notice that the cash flow of year 1 is lower than the cash flow of year 2. So where you get to a point, when you are calculating your payback period using the tabular method, when you get to a point where the outstanding balance is lower than the next cash inflow, you put a dash and you calculate your payback period. In this case, we have recovered for year 1, okay, the outstanding balance of 60,000 divided by the next cash inflow of 70,000. So put it together. This means that this project will pay back within 2 years, okay? The project will pay back within 2 years. That's the interpretation. The project will pay back within 2 years. All right. Then, what if you are given constant cash inflow or regular cash inflow? So where you are given constant cash inflow, You can either use tabular method or you use the formula. You are going to get the same answer, but it's better to use the formula because the formula is faster. Say, for example, you are given cash flow. You are told that a project with initial outlay of 500 million naira, okay? This project will generate annual cash inflows of 200 million. And the useful life of the project is 4 years. Okay, the useful life of the project is 4 years. You will notice that the cash flow given to us per annum is 200 million. So which means that year 1 is 200, year 2 is 300, I mean it's 200, year 3 is 200. So the 200 million is constant for the respective years. So in this case, there is no need for you to use the tabular method because the tabular method will waste your time. So calculating the payback period, just a payback period is equal to the constant cash inflow, okay? Constant cash inflow of 500 million. So here will be 500, sorry, cash outflow of 500 million divided by the constant cash inflow of 200 million. Okay, so this will give us 2.5 years. So this means that this project will pay back within 3 years. All right, so this is how to calculate payback period where you are given constant cash inflow. Like I mentioned, if you can also use where you have constant cash inflow, you can also use the tabular method. You still get the same thing, but that tabular method will waste your time. What do I mean by tabular method? Say, for example, now I want to demonstrate using this. Let me just use the same table, all right? Or let me see if I can get a small space here. So just create a column for year, then cash flow, then balance. Let me reduce so here will be year 0, year 1, year 2, year 3, year 4. The initial outlay is 500. Year 1 cash inflow is 200. Year 2 is 200. Year 3 is 200. Year 4 is also 200 million. Therefore, 500 minus 200 will give us balance of 300 at the end of year 1. Then 300 minus 200 will give us balance of 100 million at the end of year 2, which means that the company has recovered 400 million. At the end of year 2, the company has recovered 400 million out of the 500 million. So the company has 100 million naira to recoup from the investment or from the project. So you will notice that 100 million naira is lower than 200, which is the next one. So you put a dash, then you calculate your payback period. In this case, I need to ask myself, how many years have I recovered? I've recovered for year 1 as well as year 2. Therefore, payback period will then be equal to 2 plus the outstanding balance of 100 million divided by the next cash inflow of 200 million. So this will give us the same thing as 2.5 years. All right. So whether you use tabular method or you use the formula method where you have constant cash inflow, you get the same answer. But again, like I mentioned, there is no need for you to be going through all this stress. Once you have a constant cash inflow, just use the formula method and move on. All right, it's faster. Okay, so what's the decision rule as far as payback period is concerned? What's the decision rule? For independent projects, okay, for independent projects, accept if payback is shorter or equal to the management targeted payback period. If your calculated payback period is shorter or equal to the management predetermined payback period, then the project is financially viable. For mutually exclusive projects, accept any project with a shorter payback period, provided it is shorter or equal to the management predetermined payback period. Say, for example, you have project A and project B, and you are told that project A and B are mutually exclusive. So let's say the payback period of project A is 2.5. Project B is 2.2 years. Then the management targeted payback is 2.6, okay? 2.6. You will notice that both the payback period of project A shorter than the management predetermined payback period of 2.6. However, since the two of them are mutually exclusive, that is, you cannot accept the two projects together. So any project with a shorter payback period will be undertaken. So this means that only project B qualifies for this purpose. So the project B should be accepted. Only project B should be accepted. So that is what you need to do under mutually exclusive project. However, pay attention to what I'm about to say. In determining the acceptability of a project, at times examiner can ask you to appraise a project on the basis of the payback period, and examiner can ask you to advise whether the project should be undertaken on the basis of payback period. Now, you can only advise that the project should be undertaken if you are given the management predetermined payback period. So if management targeted payback period is not given to you, there will be no basis for the acceptability of the project. Okay, I will repeat. When in the determination of the acceptability of a project using payback period, if the management targeted payback period is not given, there will be no basis for the acceptability of the project. Therefore, under this circumstance, the most important thing you need to do is to just say that the project will pay back within 2 years, say for example, or within 3 years, whatever you have calculated. So just mention it. Like in this case now, if the management predetermined payback period of 2.6 is not given, for example, even though project B is better than project A in terms of a payback period, since I'm not given management predetermined, I will just say that, oh, the project B will pay back within 3 years, or for in two years and 2 months, or 2.2 years, whatever, however you want to put it, you are still saying the same thing. However, there will be no basis for the acceptability of project B because the management predetermined payback period is not given. That's what you are going to see on the day of your exam. But if you are given management targeted payback period, like in this case now, 2.6, of course, you need to analyze. For me, if you want to talk about that project B should be accepted, what you are going to say in this case scenario now, what you need to say is that project A produces a payback period of 2.5 years, whereas project B produces a payback period of 2.2 years. Considering the management intended payback period of 2.6 years, project B with a shorter payback period should be accepted. That's what you are going to say, because you are given the management targeted payback period of 2.6 years. Okay, so that is that. Let's talk about accounting rate of return. Again, if you like, just go ahead and read about the advantages and disadvantages. At this level, examiner cannot be asking you to be stating advantages and disadvantages, except if they want to give you as a bonus. And that's why it is just have an idea of what the advantages and disadvantages are talking about. Okay, so let's talk about accounting rate of return. Before we move to accounting rate of return, even though this one is under discounted cash flow method, that is the discounted payback period. So the discounted payback period will be calculated normally as the normal payback period, okay? The discounted payback period is calculated similar to the normal payback period, except that you use present value. Instead of the normal cash flow of the project, we are going to use present value to calculate your payback period, because you need to discount the cash flow to the present value equivalent before calculating payback period. It's the same thing, the same decision rule. So there's nothing different. All right. So that's that. Then for the accounting rate of return, the accounting rate of return is also known as return on capital employed or return on investments. Is a technique that relies heavily on the accounting information as shown in the financial statement of a company, okay? The accounting rate of return relies heavily on accounting information as shown in the financial statement of a company. The accounting rate of return is a measure of profitability, okay? The accounting rate of return is a measure of profitability, unlike the payback period that measures liquidity, okay? So in the calculation of accounting rate of return, accounting profits, accounting information is used. So where cash flow is given to you, you need to convert the cash flow to accounting information. How do you convert cash flow to accounting information? Just the same way I did for you the other time. So if in the question you are asked to calculate accounting rate of return and you are given a cash flow, you need to convert the cash flow to accounting profit or loss. How do you do this? Profits or loss is calculated as the cash flow minus annual depreciation, okay? Minus annual depreciation. So that is what you need to do, all right? So how do you calculate accounting rate of return? How do you calculate accounting rate of return? To calculate accounting rate of return, there are some 4 formulas that you must be well aware of. Okay, when you want to calculate accounting rate of return, of course, it's simply the average annual profits. Okay, accounting rate of return is calculated as average annual profits, AAP, divided by, let me push it to the front a little bit. Okay, divided by average investments, all multiplied by 100/1. So this is the formula for calculating accounting rate of return. However, on the day of your exam, you don't just jump to calculating accounting rate of return. There will be some adjustments you need to make. There will be some calculations that you need to make. So the first working that you are going to do on that day will be your depreciation, if not given to you. So you need to calculate depreciation first. All right. Average investments, AI. Okay, so you need to calculate depreciation. However, before the depreciation, of course, from this formula, you need to calculate average annual profit. Depending on the nature of the cash flow given to you. If you are given cash flow, you need to first of all convert it to accounting profit or loss before you get your average annual profit. How do you do that? Just pick the cash flow for each year. Okay, the cash flow of each year minus annual depreciation. So that will give you the profit for each year. Then you add everything together, you divide it by the useful life of the project. So this will give you average annual profit. So the difference between cash flow and depreciation will be the profits, okay? So when you add everything together, you get total profit divided by the useful life. So if in the question you are given accounting profit or loss, that's very straightforward. Just add up all the profits to get the total profit. Then you divide it by the useful life. You get the average annual profit. Then the denominator is average investment. So average investment is calculated as the cost of the project plus the scrap value divided by 2. All right, this will give you average investment. So you need to, like I mentioned, whenever you want to calculate accounting rate of return, the first working that you are going to do may be the depreciation, annual depreciation, if you are not given. Therefore, annual depreciation is the cost of the project minus the scrap value, then divided by the useful life. Okay, so these are all the relevant formulas that you need whenever you want to calculate, accounting rate of return. Okay, so what's the decision rule? What's the decision rule as far as accounting rate of return is concerned? For independent project, accept if ARR is greater than or equal to the management predetermined ARR, okay? Accept for independent project, accept if ARR is greater or equal to the management predetermined or targeted ARR, okay? Then, for mutually exclusive projects, accept any project with a higher ARR, provided it is equal to or greater than the management targeted ARR. So that's the decision rule. You will notice something in the non-discounted cash flow methods of project evaluation. Both the payback period and the accounting rate of return are benchmarked against the management targeted figure, okay? So you benchmark your results, your calculated figure with the management targeted figures, all right? So that is the basis of the acceptability of projects under the non-discounted cash flow method. So that's it. That's it. So of course, when we get to calculation, we are going to be doing all of that. But for now, let's explain the concepts, okay? So the next we want to discuss now is relevant cash flow. Let's talk about relevant cash flows. Let's talk about relevant cash flows, okay? Now, on the day of your exam, different cash flows will be given to you. So you have responsibility to be able to identify which of the cash flows are relevant to your calculation and which one is not relevant. Therefore, when you say relevant cash flows are the receipts and payments that are directly attributable to the project under consideration. So in the determination of financial viability of a project, the following item should be critically examined, okay? The following items should be critically examined. So you must know how to treat variable costs. You must know how to treat fixed costs. You must know how to treat increment. You must know how to treat before depreciation. Okay, how to treat depreciation, interest, incremental cash flow, working capital, opportunity cost, and then sunk cost. Of course, you need to include direct / specific / attributable fixed cost. Okay, attributable fixed cost. What are you supposed to do when you see each of them in a question? So let's start from the variable cost. Variable costs are costs that vary according to the activity level, which means that once the production volume changes, then variable costs will also change. Even though variable cost per unit is constant, but total variable cost will vary, will change according to the activity level. Examples of variable costs include direct material, direct labor, direct expenses, and variable overhead. So variable cost is a relevant cash flow and should be considered. All right, variable cost is a relevant cash flow and should be considered. So let's move to the second one, which is the fixed cost. Fixed costs are costs that have no sympathy for activity level. Fixed costs are costs that have no sympathy for activity level, which means that irrespective of number of units produced, fixed cost will not change. So provided fixed cost will not change, then the fixed cost is irrelevant. It's not relevant. You should not include it. However, there are three ways examiner can test you on fixed cost. There are three ways examiner can test you on fixed cost. Pay attention. So if you are given a fixed cost, no additional information, you are just told that fixed cost, the company will incur, there's a fixed cost of 100,000, all right? There's a fixed cost of 100,000. No additional information. That fixed cost is irrelevant and should be ignored. That's one. Number two, examiner can give to you fixed costs, including depreciation. If you are given fixed costs, including depreciation, that fixed cost is irrelevant. However, examiner wants you to do something. You need to calculate annual depreciation and less from the fixed costs that include depreciation. So whatever you have thereafter is relevant. Then number three, examiner can give you fixed cost excluding depreciation. So when you are given a fixed cost that excludes depreciation, that fixed cost is relevant. You need to consider it. So these are the three ways in which examiner can test you on the day of your exam on fixed cost. Okay? Now, let's talk about incremental, direct, specific, or attributable fixed cost. When you are given any of those costs, whether it is incremental fixed cost, direct fixed cost, specific fixed cost, attributable fixed cost, they are relevant, okay? They are relevant and they should be considered. You should consider them. One examiner can say direct fixed cost or this fixed cost is directly related to the project. Of course, you should know that's a relevant fixed cost. You have to consider it. Examiner can also tell you that the project will incur, there is a fixed cost of 100,000 naira. This fixed cost is specific to the project. Then you should know that that fixed cost is relevant because examiner just told you that it is specific. Or examiner can also say that the company will incur a fixed cost, or there is a fixed cost of 100,000. This fixed cost is attributable to the project. So when you see all those terminology, incremental, direct, specific, attributable, so you should know that they are relevant fixed costs. So you need to consider it. Okay, let's talk about depreciation, amortization, or provision. Okay, depreciation, amortization, or provision. These are notional costs. These are notional costs that does not consider, that does not involve movement of cash. These are notional costs and does not, and do not involve movement of cash, which means that anywhere in a question you see depreciation, amortization, or provision, they are not cash flow, they are notional costs, therefore should be ignored, they are irrelevant. All right? Depreciation, amortization, provision are irrelevant, should not be considered. Okay, because they are not cash item. Move to the next one, interest. Interest. Interest is the compensation required by the provider of debt capital. It represents the actual amount paid on the loan borrowed. Therefore, the absolute amount of interest, that is the naira amount. If you are given interest of 10,000 naira, for example, this is what is called absolute amount. So the absolute amount of interest is irrelevant and should be ignored. This is because the cost of capital to be used to discount the future cash flows already included interest. You know, when we calculated weighted average cost of capital, we calculated cost of equity, we also calculated cost of debt. That cost of debt, of course, we use it to calculate WACC. So the WACC is already included interest because before you calculate cost of debt, you must have considered interest, you know, whether it is after tax interest or where tax is given or where tax is not given, whatever the case may be, we have considered interest, the coupon payment. All right, so because the cost of capital already included interest, then the absolute amount of interest, which is the naira amount, should be ignored. Okay, should be ignored, it's not relevant. So whenever you are given interest expense in a question and you want to determine cash flow, you want to know whether you should include it as part of the cash flow for the project, please don't include interest. The absolute amount of interest is irrelevant and should be ignored. When you do that, when you include the absolute amount of interest, that means you are double dipping, which means that you are treating interest twice. Okay, when you double dipping. Okay, double dipping. It means you are treating interest twice. When you treat something twice, that means you are double dipping. So that is how you are going to treat interest. Then let's talk about opportunity cost. Okay, before we talk, working capital is the last thing we are going to discuss there. So let's talk about opportunity cost. Opportunity cost is the benefit forgone as a result of the decision taking. All right, opportunity cost is a relevant cash flow and should be considered. How would examiner may not tell you in a question that there's an opportunity cost. No, a scenario will be painted, and from that scenario, you'll be able to deduce that it is opportunity cost. For example, As a lecturer, let's say I have a car. I can use my car for Uber service to generate revenue. So if I decided to drive myself to the center, okay, if I decided to drive myself to the center, that means I will not be able to earn the revenue through Uber service. Therefore, when I want to determine the cost of my lecturing, the benefits that are supposed to accrue to me through Uber service, I'm going to add it as part of the cost of my lecturing because I cannot earn that benefit again. It's lost. So the benefit forgone as a result of undertaking a cost of action is what is known as opportunity cost. Another example is that, say for example, a company wants to undertake a project and there will be need. That project will require a storage unit where you are going to keep the equipment or whatever. So if there is a neighboring business that want to rent the space, the storage unit or the storage space, of course, because the company wants to use the storage space for the project, they will not be able to earn the revenue from the neighboring business. Therefore, the rental income that would have accrued to the company will be lost. That is an opportunity cost. So it should be part of the cost of the project. Okay, so let's talk about sunk cost or historical cost. Okay, the historical cost is the original amount incurred, okay, is original amount incurred previously, or is a sunk cost is a cost that have already been incurred. Any past cost is a sunk cost, and any sunk cost is irrelevant cash flow and should be ignored. Examples of sunk costs include market survey. On the day of your exam now, if you have any question on that capital budgeting, certainly you are going to be given. You can't escape it. Examiner will surely give to you sunk costs. So example of sunk costs include market survey cost, okay, feasibility study fee, the research and development cost or development cost. All right, so when you see any of those items in a question, you should know that they are irrelevant and should be ignored. So finally, let's talk about working capital. The working capital represents the amounts required for the day-to-day running of a business. It represents the difference between the current assets as well as the current liability. Okay, working capital represents the difference between current assets and then the current liability. So in the determination of relevant cash flow, the working capital should be considered, and then it should be treated as a the working capital should be treated as follows, depending on the nature of the cash flows. If you are given a one-off working capital, okay, for working capital, let me write it out, working capital. So if you are given a one-off working capital, this one-off working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life of the project. I repeat, a one-off working capital should be treated as a cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. What do I mean by a one-off working capital? Say, for example, you are told that a company will incur a working capital of 5,000 naira, okay? A working capital of 5,000 naira in year one, okay? In year one. Let's say the useful life of this project is 3 years for simplicity. 3 years is the useful life. So this is information given to you on working capital. How do you treat this working capital? You can see it's this working capital occur once. That means a one-off working capital. So when I want to treat this, I will create a column for year 0, year 1, year 2, then year 3. The rule says that working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. This working capital occur at the end of year one. Therefore, I'm not going to indicate it in year one. Year before year one is year zero. So I will then come here, year zero, 5,000. The rule says that it should be treated as cash outflow in the year before the year of occurrence. Then at the end of the useful life, the end of useful life is 3 years. Then I should recover the entire 5,000. With this, my working capital will be equal to 0. That means I've recovered the entire working capital. Say, for example, again, the cash flow of 5,000 will occur at the end of year 2. For example, I will not indicate it in year 2. Year before year 2 is year 1. So I will then come to year 1. I will indicate 5,000. Okay. Then at the end of the useful life, which is year 3, I will recover the 5,000. All right. So if the working capital, for example, if the working capital occur in year 3, at the end of year 3, I will not indicate it in year 3. Year before year 3 is year 2. So I will then come here to be treated as cash outflow in the year before the year of occurrence. Then at the end of the useful life, which is year 3, I will recover it. So this is how to treat a one-off working capital. This is how to treat a one-off working capital. Then, number B, for incremental working capital. This is very common. This is what you may likely see, especially at this level on the day of your exam, if you have capital budgeting question. So examiner may give to you working capital, incremental working capital. So how do you treat incremental working capital? The incremental working capital should be treated similar to a one-off working capital, except that only the increment should be considered. All right, only the increment should be considered. What do I mean by increment? Say, for example, let me look for a space. Say, for example, all right, you are given working capital. You have year 1, year 2, and then year 3. We are now given working capital for year 1 to be 500, year 2, 600, year 3, 800. You will notice that capital is increasing on a yearly basis. So when you have this kind of a cash flow, when you are given this kind of a cash flow or this kind of information, the 600 and the 800 is irrelevant. All right. All you need to do is to determine the incremental working capital. I will then create another row to say incremental. Okay, incremental working capital. Incremental because of space. Working capital. The one that I'll call in year 1. Let me push that one to the back. Okay. Incremental working capital. The one that I'll call in year 1 still remain 500. The one that I'll call in year 2, working capital has increased from 500 to 600 by 100. Working capital has also increased from 600 to 800 by 200. So we can only consider the increments. Therefore, these are the ones that you are going to recognize. It's only the increment that you are going to recognize. Then in your table for calculation of NPV, you may want to consider the relevant year where you are going to treat, where you are going to put the incremental. The capital that occur in year 1 of 500 should be treated as cash outflow in year 0, because year before year 1 is year 0. The one that occur in year 2 of 100 should be treated as cash outflow in year before year 2, which is year 1. The one that occur in year 3 of 200 should be treated as cash outflow in the year before year 3, which is year 2. Then at the end of the useful life of the project, which is year 3, I will recover the entire working capital. The highest working capital is 800. That is 500 plus 100 plus 200 will give us 800. This is how to treat incremental working capital. With this, I've recovered the entire 800 as my working capital. This is how to treat working incremental working capital. And like I said, this is what you may likely see on the day of your exam if you have any question on capital budgeting. So let me know if you have any question for me before we move to inflation in capital budgeting. All right. Any questions so far? Okay, so if there's no question, let's move to inflation in capital budgeting. Now, I will not dwell too much on this as far as inflation is concerned. So just go and read it. I can't be telling you what
Hello,
is
sir.
inflation.
Hello, sir.
Yes,
So, like
talk
this
to me.
cash flow now they've given, what about if there's a decrease within the year, how will you treat it?
Yes, what this simply means is that what informer is saying, if I get that correctly, is that, say for example, you have a working capital of in year 1, year 2, year 3, for example, you are given a working capital of 500. Then, of course, this has increased to 600. Then, in year 3, it now reduced to 400. Is that not what you are saying, Ufoma?
Yes, sir.
Aha. So, this is what you are going to do. We are going to have a scenario that relates to that as we proceed. Now, when working capital is increasing and it starts falling, it means that the company has recovered part of the working capital. Like in this case, working capital has increased from 500 to 600. The highest working capital is 600. So in year 3, the working capital has dropped to 400. It means that the company has recovered part of the working capital, which is 200. Company has recovered 200. In this case, what am I supposed to do? Of course, in year 1, the working capital will be 500. In year 2, the working capital to recognize will be 100. Okay. Then in year 3, of course, the difference between 400 and the difference between 600 and 400 is 200. All right. Let me look for, okay, let me see if I can manage that space. Therefore, the rule says that working capital should be treated as cash outflow in the year before the year of occurrence and recover fully. So the one that occur at the end of year 1 should be treated as cash outflow in year 0. The one that occur at the end of year 2 should be treated as cash outflow in year 1. The one that occur in year 3, which is in this case is 200. That 200 is a recovery because your working capital has dropped to 200. So you are not going to treat it as cash outflow. So in year 2, that 200 you are seeing there is a recovery of the working capital because your highest working capital is 600. Then at the end of use 5, which is year 3, you are going to recover the balance, which is 400. That's it. 400 minus 0 will give you 400. So in this case, in year 3, you are going to recover 400. Out of the 600, you have recovered 200 in year 2. Then the balance of 400 will be recovered in year 3. When you had 500 plus 100, that's 600. 200 plus 400, that's 600. With this, I've recovered the entire working capital. So when a working capital is increasing and it starts falling, then it means that the company has recovered part of the working capital. So like I said, there is a scenario, there's a past question that relates to that. When we get there, you will be seeing how we are going to treat it. I believe this is clear to you, Ufoma.
Yes, sir. Thank you.
You are welcome. So let's talk about inflation. Like I was trying to say, so you need to read the details as per inflation, everything as per inflation. My focus is just to give you the key points, what you need to know as far as inflation is concerned. I can't be telling you what is inflation and what is general inflation, specific inflation. So examiner cannot be asking you all of that on the day of your exam, but it's good to know, at least to have the idea, okay? All right then. Now, for the purpose of inflation, generally there are two types of cash flow. We have money cash flow. We also have real cash flow. Money cash flows are cash flows that include the possible effect of inflation. I repeat, money cash flows are cash flows that include the possible effect of inflation. They are inflated cash flows. And unless otherwise stated, the cash flow given to you represents a money cash flow. Now, what do you understand by real cash flow? The real cash flow are cash flows that does not include the possible effect of inflation. They are cash flow that is stated in today's prices, year zero prices, year one prices, or current value terms. So when you are given a cash flow, say for example, you are given selling price and you are told that selling price 2,000 naira in year one. Because the examiner has mentioned year one, it means that that selling price is a real cash flow. Again, the examiner can tell you that variable cost of 1 million naira. The current variable cost is 1 million naira. Because the examiner has mentioned current, that means that variable cost is in current value terms. So if it is in current value term, that means it's a real cash flow. And that's why I'm saying that real cash flow are cash flow that are stated in today's prices, year one prices, year zero prices, or current value terms. All right, current value terms. So that examiner can ask you to explain what is money cash flow and real cash flow. You must know what you are doing. All right, so that is that. Similar to cash flow, we also have money discount rates as well as the real discount rates. Okay, we have money discount rates and then the real discount rate. The money discount rates is also known as nominal discount rates. It is the cost of capital that include the possible effect of inflation. Again, except examiner says otherwise, the cost of capital given to you represents money cost of capital. Then what do you mean by real cost of capital? The real cost of capital is a cost of capital that does not include the possible effect of inflation. It is a cost of capital that is stated in real terms. All right. It's a cost of capital that is stated in real terms. All right. So how do you calculate, how do you determine money cost of capital or real cost of capital or even general inflation rate? For the purpose of inflation, when you want to determine money cost of capital, real cost of capital, or general inflation rates, you are supposed to use Fisher effect formula. Okay, you are supposed to use Fisher effect formula. The Professor Ivan Fisher is the one that developed the formula. He is an economist. Okay, so he was the one that developed the formula. According to Professor Ivan Fisher, let me see, so that I don't, okay, is here. So according to Professor Ivan Fisher, 1 plus m, okay, 1 plus m is equal to, remove the brackets. 1 plus m is equal to 1 plus r multiplied by 1 plus general inflation rate. So this is the original formula from Professor Ivan Fisher. So m is the money cost of capital, r is the real cost of capital, I is the general inflation rate. So if in a question you are given real cost of capital and you want to convert it to money cost of capital, this is the formula that you are going to use. So I want to make m the subject of the formula because m is the money cost of capital. So from this original formula, then all I need to do is to just push the one that is standing behind the m to the other side. Therefore, I will say 1 plus r multiplied by 1 plus general inflation rate, all minus 1. So this is the formula for calculating money cost of capital. That's the formula for calculating money for cost of capital. If I want to calculate real cost of capital from the original formula, I want to make R the subject of the formula. So all I need to do is to divide both sides by 1 plus general inflation rate. Therefore, I would then say R is equal to 1 plus money cost of capital divided by 1 plus general inflation rate, all minus 1. So this is the formula for calculating real cost of capital. If I want to calculate general inflation rates, I want to determine I. I is not given in the question. Therefore, general inflation rate, same way you calculate the real cost of capital. So general inflation rate will be 1 plus money cost of capital divided by 1 plus real cost of capital. All of this minus 1. So this will give us the general inflation rate. So these are all the relevant formulas. But in most cases, this is what you may likely calculate for. If in the question you are given real cost of capital, and then you have converted your real cash flow to money cash flow, then that is the formula. You are going to calculate money cost of capital. Again, if you are given money cost of capital and you want to convert it to you have converted it to, you are given money cash flow and you have converted it to real cash flow. Then because you need to use real cost of capital, and if you are given money cost of capital, you need to convert it to real cost of capital. To do that, this is the formula you are expected to use. So that is basically what you need to know as far as inflation, impact of inflation is concerned. Now, in addition to this, there are general rules. There are general rules you need to understand. Rule number 1 is that money cash flow should be used for money cost of capital. Okay? Money cash flow should be used for money cost of capital. And then rule number 2, real cash flow should be used for real cost of capital. Rule number 3, money cost of capital should not be used for real cash flow. Then rule number 4, real cost of capital should not be used for money cash flow. But most importantly, when cash flow are stated in year 1 prices or first year prices, inflation should start from year 2. Okay, I repeat, when cash flows are stated in year 1 prices or first year prices, inflation should start from year 2. What do I mean by that? If you are given a first year price or year 1 prices, if you are given a year 1 prices, you don't inflate that year 1 price in year 1. You need to start inflating from year 2. Why did I say so? Because the first year price given to you is your base year price. Your base year price is what you are going to use to project for the future. Say, for example, you are given a selling price. You are given a selling price of 2,000 naira. Selling price of 2,000 naira in year 1 prices. Okay, you are told that selling price of 2,000 in year 1 prices. That's what the examiner has just told you. So this means that this 2,000 is a real cash flow. The 2,000 is a real cash flow. So if I want to inflate, say for example, inflation rate is 5%. If I want to inflate the selling price, and let's say for example, the useful life of the project is 3 years. So I will do for year 1, year 2, year 3. The selling price given to me of 2,000 in year 1, because the examiner has told us that is in year 1 price. Inflation rate is 5%. Therefore, I would then say 1.05. If I want to do primary school method, all right, I will just say 2,000 all through. I will repeat 2,000 across all the relevant years. You shouldn't be doing this on the day of your exam. It's a waste of time. Okay, so this is the selling price given in the question. Then I will then introduce inflation. Inflation at 5%. So remember, when you want to convert money cash flow to real cash flow, of course, it is simply money cash flow is calculated as real cash flow multiplied by 1 plus inflation rates raised to power n. When you do this, you are compounding. I don't usually do this in the class, so because it is implied, you don't need the formula for anything. So what I'm trying to say in essence is that this 2,000 is a real cash flow. I want to inflate it. I want to convert it to money cash flow. Therefore, I would then say 1 plus I raised to power n. In this case, this one, the inflation rate is 5%. I will say 1.05 raised to power 0, 1.05 raised to power 1, 1.05 raised to power 2. So when you do this, you will notice that, of course, you know that anything raised to power 0 is equal to 1. Therefore, 1 multiplied by 2,000 is 2,000. So that means, of course, this is the inflated selling price. That's inflated selling price. So with this, I will then move to year 2. 1.05, okay, 1.05 raised to power 1. Okay, 1.05 raised to power 1 equal, then multiply by 2,000 equal, that's 2,100. Here is 2,100. I've inflated for year 2. Then for year 3, I will also say 1.05 raised to power 2, okay, raised to power 2 equal, then multiply by 2,000 equal, that's 2,205, 2,205. With this, I've also inflated the cash flow. You will notice that in year 1, the cash flow remained as 2,000. So this is what I'm trying to say. When you are given a cash flow in year 1 prices, inflation should start from year 2. The fact that I said inflation should start from year 2 does not mean that you are going to say raised to power year 2. No, it will still say raised to power year 1. All right. Okay. So again, on the day of exam, instead of you to be doing all of this, it's a waste of time. Just comment and say selling price. Okay. In year 1, selling price in year 1 is 2,000. The inflation rate is 5%. So just carry your calculator by saying 1.05. Okay. 1.05 multiplied by 2,000. That will give you 21. 21 multiplied by 1.05. That will give you 2205. You can see instead of 3 line items, 1, 2, 3 line items, I only have 1 line item. So you are still doing the first one. I've already moved on to the next level. So you don't need to be doing this primary school on the day of your exam. Just you should know what will make your work faster. All right. Provided you know what you are doing. If this primary school method is what you understand the most, please do it. Anything that is more convenient for you is what you should do. Okay, so that is basically what I mean by cash flow. When you are given a cash flow that is stated in year 1 prices, it should be treated as cash out. It should be inflation should start from year 2. So that's basically what I'm trying to say. The second part, where cash flow are stated in today's prices, year 0 prices, or current value terms, inflation should start from year 1. Okay, inflation should start from year 1. So again, this is what I'm saying. If, for example, say you are given a variable cost of 1,000, you are given variable cost of 1,000 naira. Okay. In current, examiner now told you that in current value terms, in current value or in current times. So you are given the information just as this. So because the examiner has mentioned current value terms, it means that this 1,000 naira is a real cash flow. So when you now want to convert it to money cash flow, say for example, the project has 3 years life. I would then say year 1, year 2, year 3. variable cost, the inflation rate, say for example, inflation rate also, we are given inflation rate of 5%, okay? We are given inflation rate of 5%. So I would then say at 5%. The 1,000 will not appear anywhere. So I'll just carry my calculator to say 1,000 multiplied by 1.05 equal, that's 1050. Here is 10 in year one, it is 1050. In year two, I will then continue my calculation. 1050 multiplied by 1.05 equal 1103. Here is 1103. Then what I have in my calculator, if I want to do for year three, whatever I have in my calculator multiplied by 1.05 equal, that's 1158. Here is 1158. With this, I've inflated the variable cost. So this is what you need to do when you are given a cash flow that is stated, when you are given in current value terms, okay? When you are given cash flow in current value terms, inflation should start from year one. You will notice that 1,000 did not appear anywhere in my calculation. So that is what you need to do for the second rules I just told you. So the rule I mentioned to you that you should consider the following: where cash flow are stated in year one prices or first year prices, inflation should start from year two. The fact that inflation should start from year two does not mean that you are going to raise number of years into two. So of course it has to be to still be one, okay? All right, for the first one. Then where you are told that cash flow is stated in today's prices, year zero prices or current value term, then you should start inflating from the first year. So that is basically inflation. This is how to incorporate inflation in capital investment. So the next thing we want to do now is to discuss impact of taxation in capital budgeting. Before we move to taxation, let me know if you have any question for me. Do you have any questions? So far, so good. If not, let's move to discussing taxation. Okay. Now, again, I will not bother you with too much of a story as far as taxation is concerned. One thing you need to understand is that, you know, when we were discussing relevant cash flow, we said that depreciation, amortization, provision are irrelevant because they are notional costs. They are not cash items. Now, as far as depreciation is concerned, for the purpose of taxation, depreciation is a disallowable expenses because different methods are used by companies to determine their depreciation charge for the respective years. However, for the purpose of in capital investments or in finance generally, capital allowance is granted in lieu of depreciation. When a company incurs qualifying capital expenditure on non-current assets like building, plant and equipment, machineries, and stuff like that. So the company is expected to claim capital allowance on the qualifying assets. All right. There are basically three major reasons or purpose of incorporating taxation in capital investments. One is to determine the tax liability, that is, the amount of tax the company will pay on the project when the project makes profits, okay? So tax liability is one of the purpose of incorporating taxation in capital investment. Two, to determine the tax saved on capital allowance, all right? Another reasons for incorporating tax is to determine tax saved on capital allowance. Like I mentioned, capital allowance is an allowance granted to a business for incurring qualifying capital expenditure. All right. So the essence of capital allowance is to reduce taxable profits and in effect tax liability. Therefore, to get the tax saved on capital allowance, you need to multiply the company tax rates on the capital allowance computed. Okay. Then number 3 reasons for incorporating tax in capital investments is to determine the timing of the cash flow. That is, when is the tax liability going to be paid, or when is the capital allowance going to be claimed? Are we going to pay the tax liability in the current year or in arrears? This is what is meant by the timing of the cash flow. These are the 3 main reasons or purpose in which taxation is incorporated in a capital investment. Now, for the purpose of determining financial viability of a project, or in the determination of financial viability of a project, there are 4 types of capital allowance. There are 4 types of capital allowance. 1 is initial allowance, 2 is annual allowance, 3 is balancing allowance, then 4 is balancing charge. The initial allowance is an allowance granted to a business once in the lifetime of an asset, okay? The initial allowance is an allowance claimable or granted to a business once in the lifetime of the asset, meaning that once the company claims, once you multiply the initial allowance rate on the cost of the asset, you can't claim it again. It is only once and for all. Then the second one is annual allowance. Annual allowance is an allowance claimable every year until the final disposal of the asset. Okay, annual allowance is an allowance claimable every year until the final disposal of the assets. Then the number 3 is balancing allowance. The balancing allowance will occur when the tax resident value from the preceding year is higher than the sales proceeds. Okay, if the current worth of the assets is more than what the asset is being disposed of, then it means that the company will claim balancing allowance on the difference between the tax resident value and the disposal value. Okay, say for example, you have an asset that have a tax rated down value of 200 million, for example, and this asset is being disposed of, sales proceed. This asset is being disposed of at 150 million. So the asset that worth 200 million is disposed at 150 million. So when this happens, the difference between 200 and 150, which is 50 million, this 50 million is called balancing allowance. So the company will claim balancing allowance of 50 million. So balancing allowance will occur when the tax written down value from the preceding year is greater than the sales proceeds at the disposal of the asset. Okay, then the balancing charge is similar to balancing allowance, only that balancing charge occurs when the tax written down value from the preceding year is less than the sales proceeds. Again, say for example, you have a tax written down value of 200 million. Then you are given the sales proceeds. This asset was disposed of at 220 million. So the asset is disposed higher than the worth. Therefore, the difference of 20 million is what is known as balancing charge. So this means that this company has earned additional income or additional gain, has made additional gain of 20 million. That extra income will be taxed in the hand of the company. So that is a balancing charge. All right, so you need to watch out. Of course, balancing charge will always be in brackets. Okay, I will show you the formats as we proceed. All right, so these are the types of capital allowance. Okay, for a very long time, I've never seen any question that include the initial allowance. But if you have on the day of your exam, because you never can tell, examiner can decide to perform wonder. But in any case, the bottom line is that to get your initial allowance, just multiply the initial allowance rates. Initial allowance rates, you multiply it on the cost of the assets. So that will give you your initial allowance. Then annual allowance too. Multiply your annual allowance rates on the cost of the asset or on the tax written down value, depending on the method that you want to adopt. Okay. So that is how to calculate, or that is the types of capital allowance. Then let's talk about methods of calculating capital allowance. Basically, there are two methods of determining capital allowance for the purpose of determining financial viability of a project. So we have straight line depreciation method. We also have reducing balance method. For the straight line depreciation method, it's the same amounts that you are going to have every year, the same annual allowance you are going to claim every year until the final disposal of the assets, where you are going to compare the sales proceeds with the tax rated down value. Okay, so it's the same amount. So say for example, this asset has 5 years life and the asset cost 1,000. Just divide you calculate the cost minus scrap value divided by 5. Okay, so that will give you every year is the same amount. Is the same amount you are going to be getting. Then, if you are using reducing balancing methods, for the reducing balance method, in the first year, you are going to multiply the annual allowance rates on the cost of the asset. Then subsequently, you are going to be multiplying the annual allowance rate on the tax rated down value. Okay, so that's just the difference between the straight line and then reducing balancing basis. All right, so that is that. Then, yeah, I've already mentioned this timing of the cash flow. Examiner may tell you if in the question examiner, there are two, when you want to determine when to claim capital allowance or when to pay the tax liability. The tax liability can be paid in the current year or in arrears. So if it's in the current year, it means that the year in which the profit is earned is when you are supposed to pay the tax. Okay, the year the profit is earned is when you are going to pay the tax. However, if you are told that tax will be paid 1 year in arrears, then it means that after year 1, after 12 months, is when you are going to, the profit of year 1 will be taxed in year 2. The profit of year 2 will be taxed in year 3, on and on like that. So there must be 1 year lag. But if in a question the examiner is silent, you are not told when to pay the tax liability, then you are going to assume tax will be paid in the current year. So your capital allowance will follow the patterns of your tax liability. You should know that capital allowance must follow the pattern of your tax liability, meaning that if your tax liability is in the current year, your capital allowance must be claimed in the current year. If the tax liability is in arrears, then capital allowance must also be in arrears. So these are the things you need to take into consideration. When you see live question, I will be demonstrating that as we proceed. Now, I mentioned to you the other time, the reasons for claiming capital allowance generally is to reduce taxable profit for the purpose of final reduction of the tax liability as a direct consequence of incurring qualifying capital expenditure. So once a company incurs qualifying capital expenditure, the company is expected to claim capital allowance. The capital allowance will be claimed in order to reduce your tax liability, because once you deduct your capital allowance from your profits, then that will reduce your taxable profit as well. Because, yeah, so that is for that. Then, how do you calculate tax saved on capital allowance? How do you calculate tax saved on capital allowance? This is the format that you can use to calculate tax saved on capital allowance. So when you want to do this, so you are going to pick the cost of the assets. You put it there. This is the cost of the assets. Then in year 1, you want to calculate capital allowance for year 1. So in this case, you go to the question, if you are given initial allowance rates, you're also given annual allowance rates. Okay? If you have the two together, then you go ahead in the question, you multiply the initial allowance rate on the cost of the assets. Whatever you have, you put it there. You also multiply the annual allowance rate on the cost of the assets. Whatever you have, you put it there. You add the two together. So in year 1, it means that you are going to have the initial allowance rate plus the annual allowance rate. That's what you are going to put there. You have to do your working separately. So that's what you are going to put there. So the capital allowance you have claimed in year one minus the cost of the asset will give you the tax written down value at the end of year one. You then move to year two. So subsequently, after the first year, it will be annual allowance. Therefore, you need to multiply the annual allowance rates on the cost of the on the tax written down value. We're assuming that is on reducing balancing basis. So just multiply the annual allowance rate on the tax written down value to get the capital allowance for year two. Then you find the difference, which is the tax written down value at the end of year two. We're assuming that this asset has 3 years life. So year three is the final year of the asset. At this final year, you need to compare the sales proceeds with the tax written down value. So let's say this is the sales proceed. You less the sales proceed from the preceding from the tax written down value from the preceding year. So if the tax written down value is greater than the sales proceed, it is called balancing allowance. That's balancing allowance. But if the sales proceed is higher than the tax written down values, it is called balancing charge. That is the balancing charge. All right. So that is what you need to do. So what you have here, and this, and the third one, and this are your capital allowance. Those are your capital allowance. When you now want to determine tax saved on capital allowance, so you need to multiply the company tax rates on the capital allowance. So to get tax saved on capital allowance, just multiply company tax rates on the capital allowance. So the capital allowance you have in year one, you multiply the company tax rates with it to get this. Say, for example, the company tax rate is 30%. So, and then the capital allowance in year one is 1,000. So 30% of 1,000 will give us 300. That's the tax saved on capital allowance in year one. You move to year two. Let's say the capital allowance in year two is 800. Then 30% of 800 will give you 240. Okay. For example, that's 240 tax saved you are going to have in year two. Then at the end of the final year, which is whether it is balancing allowance or balancing charge, just multiply the company tax rates on the different, whether it is balancing allowance. Okay, this could be positive or negative, depending on whether it is balancing allowance or balancing charge. That is that. That is how to calculate. That is how to calculate the tax saved on capital allowance. Just master the format. Okay, master the format. Now, there's one more thing that I need to, okay, in this particular material, you don't have the format for calculating NPV. So I will show you now. However, yes. So let me see. Now, you may want to confirm whether the capital allowance you have computed, whether the tax saved on capital allowance you have computed is correct or not. There's a formula to do that. If you want to know the total tax saved is calculated as the cost of the assets minus the scrap value, all of this multiplied by the company tax rate. Okay, I have it here. This is the information there. All right. So the total capital allowance, the total tax saved must be equal to this formula. Okay. The total tax saved that you have computed here, this total tax saved you have computed here must be equal to the formula here. So if it is not equal, then something is wrong somewhere. The only difference cannot be more than one, maybe one, just due to rounding. Okay. So, but in any case, this is the formula for you to confirm whether it is correct, whether your capital total tax saved is correct or not. So that's the formula we are expected to use to do that. So finally, let me give you the formats that you can use to calculate NPV, internal rate of return, project duration, whatever, given a multiple variables. So if in a question you are given a multiple variable, then you are expected to use a columnar format. Let me see if I can get a bigger space. So you are expected to use a columnar format to compute your NPV. Okay, let me show you. Whenever you want to compute NPV or you want to calculate modified internal rate of return, or you want to calculate project duration, okay, or even payback period, and you are given multiple variables. In the question, you have sales value, you have variable cost, you have attributable specific fixed cost, you have taxation, you have inflation, you have scrap value, you have initial outlay, you have working capital. All relevant variables are given to you in that question. Then in that case, you cannot use the smaller table for calculating NPV. Rather, you need a columnar format. Okay, so let me show you the format for calculating NPV. Calculating net present value, NPV. Okay, I hope this space will be sufficient. Okay, so let's say this project has 3 years life. So I would then say year 0, year 1, year 2, then year 3. You need to create additional column for workings. Okay, so in the question you are given sales value, you are given selling price, then you need to go and calculate your sales. How do you get your sales? You go to the question, you pick the selling price. If you are given inflation rate, then you inflate the selling price, you multiply with number of units sold, then you need to come and post. Working number 1. Then in the question, you are also given variable cost. You go to the question, what is variable cost per unit? You multiply the variable, before you multiply the variable cost per unit with number of units produced, you need to consider if you are given inflation rate on variable cost, then you inflate the variable cost, you multiply with number of units produced, then you come and post. It's a cash outflow. Working number 2. You also go back to the question and check, in case you are given a specific or attributable fixed cost. All right. In this case, there is no need for you to be doing calculation for attributable specific fixed cost. Just multiply the inflation rate, inflate the fixed cost, then you come and post. If you do working for that, no problem, but it's a waste of time. So any other cash flow you are given in the question, you consider it. All right. Then of course, find the difference. Okay. So this represents the profits. Immediately after the profit, you are supposed to pay tax. So I would then say taxation. You multiply the company tax rates. You multiply the company tax rate on the profits. With this format, our assumption is that tax is paid in the current year. So the year the profit is earned is when the company will pay tax liability. Immediately after the tax liability, you need to consider tax saved on capital allowance. Tax saved on capital allowance. So you need to go and do your working for tax saved on capital allowance. As I've shown in the format above, okay? You calculate your tax saved on capital allowance, then you come and post. So this will reduce your tax liability. So working number 3. Then, if in the question you are given scrap value or sales proceed or receive value or net realizable value, whatever it is called, or trading value, just come and put your scrap value here. Scrap value will occur at the final year. So then in the question, if you are given, of course, there will be initial outlay, the cost of the project. Okay. The cost of the initial outlay will occur at the beginning of the project. Okay. Initial outlay will occur at the beginning, which is year 0. So put it there, it's a cash outflow. It is also possible you may be given working capital. Working capital. Now, you need to go and do your working on working capital. All right. You need to go and work out your working capital. Are you given incremental working capital or a one-off working capital? Based on this format, our assumption is that we have a one-off working capital, and this one-off working capital will occur in year 1. Therefore, we are going to treat it as cash outflow in year 0. At the end of the useful life, we recover the working capital. Okay, so that's our assumption on that. Then we determine the net cash flow. So with this net cash flow, you can use any technique to appraise the project. With the net cash flow, you can use any technique to appraise the project. You can use NPV, you can calculate NPV, you can calculate internal rate of return, you can calculate project duration, you can calculate payback period. The only thing you cannot use this format for is the accounting rate of return, because you need accounting profit for you to be able to do that. All right. So then immediately after the net cash flow, you need to discount the cash flows. So you now have discount factor at whatever percentage. It is also possible examiner may say you are the one that will calculate the cost of capital. So in number A, you may be asked to calculate cost of capital. Then number B, advise whether the project should be undertaken. Whatever the case may be, so you should know what to do. All right. So that is that. So you put the discount factor here. Year 0 is always 1. You put all the discount factor there. Then, of course, you get the present value. This is the present value. Then, after the present value, you get your NPV. You get the NPV. That's it. That's it. So NPV could be positive or negative. This is the net present value. All right, so this is the columnar format that you can use to compute the net present value. Okay, so that is it. You need to master the format. So from this moment on, all what we are going to be doing are just calculations. So that's it. That's it. This is how to calculate the net present value. So let me know if you have any question for me. 4 of you have disappeared. No worries. Tony is still on. Chidima, Christiana, Faith, Igbagbo, Wumin is on. Mercy is on. Lukma, Roberts, Ufoma. Okay, Ibukun has disappeared. Then Eno has also disappeared. Okay, those are the 2 of them I remember. But in any case, so that's that. This is how to calculate the net present value. So far, so good. We have completed the discussion on the underlying concept, the discussion of the underlying concept of capital budgeting. All right. During the course of this previous class and today, we have discussed NPV, internal rate of return, modified internal rate of return, project duration, okay, project duration, discounted payback period. We'll talk about payback period, accounting rate of return. We also talk about how to identify relevant cash flows. We talk about impact of inflation and taxation. And now I've given you the columnar format to calculate the NPV. So that is that. Let me see if I can find a question that we can complete within for the remaining minutes that we have. Okay. Other than that, possibly we push it to our next class. Let me see. Okay, let's start afresh. Let's start afresh in our next class by the grace of God. Okay? All right then. Thank you guys for your time and understanding. I will see you next week by the grace of God when we shall continue the class. All right. So going forward, all what we are going to be doing are just calculations. All right. Since we already know, we've already discussed all the relevant concepts. So I want to encourage you to go back to your notes, ensure that you follow through all what we have discussed so far, so that in our next class, it will be easier for you to follow through as we are solving questions. Okay? Thank you, everyone. I will see you next time by the grace of God. Bye-bye.